Hi, I'm Paige Deers. I'm here at the MBA conference in Atlanta, bringing you insights from lenders. And I am here with David Auerbach from Archetype Mortgage Capital. And we're talking about CMBS origination. There was a lot of talk at this show last year, very bold talk about numbers as high as 50, 70 billion we might see for 2011. Really only came in between 30 to 40. We're looking at what CMBS will do this year, David. And as an originator, what can we expect from shops like yours?
Absolutely. Archetype's goal for 2012 is roughly 1.25 billion. We think that's very achievable, but what's really going to dictate if we can get there is going to be a couple different things. Obviously, spread stabilization. We need to keep the sponsors that are borrowing our funds confident in our execution, and we need to be able to have some conviction with them and let them trust our spreads. Secondly, is going to be acquisition volume. I think we all know that the refi maturities are coming out of vintage CMBS deals, but we need the investment community to start acquiring more assets, and we need to see a pickup in transaction volume, and that's what, in my opinion, will really dictate staying above or below Archetype's goal of $1.25 billion, and then I think the whole industry's goal, which is probably to exceed the 30+ billion that was securitized in 2011.
Well, let's talk about that appetite for risk, because there's not a lot of people that are holding perfect product. And there are a lot of secondary markets and product types that really need some help. They're going to look at CMBS. So how is your appetite for that risk, and how do you really choose that product in secondary markets?
Great question. Our appetite is high. We are not a zero risk type shop. We're not looking to underwrite and originate deals where we button up every piece of event risk throughout the term of the loan. We're just looking for rationalization. Our company is wholly owned by L&R, which makes us, and historically we've been the most prolific acquirer of B pieces in CMBS 1.0, and are obviously very active in CMBS 2.0, which gives us the unique opportunity to basically stress asset classes against what has historically performed well or not performed well in our servicing portfolio. So, we're not saying no to deals just because they're unanchored retail, or we're not saying no to deals just because they're not located in a top 5 MSA. We're looking for deals that make sense. We're looking for deals that have historically performed well throughout the downturn. For example, the best built-in stress test any asset can show to a new, to a lender is how did it do in 08, 09, 2010 during the economic downturn? If the property performed well, we'll look at that and say, hey, it will probably do well in the future. We're also very sensitive to the pedigree stuff. We look at most recently signed leases, all the typical stuff to determine the most, indicative point of market rent and that kind of stuff. So we're not against unanchored retail. We're not against hotels. We love all the national product types. We love the good stuff too. But we're not the shop that has a specific matrix that says the buck stops at X LTV or Y MSA. We look at everything open-minded.
Well, that is going to be some really good news for a lot of borrowers. They're going to be happy to hear that, David. So let's talk about CMBS, because if a borrower is looking at that, it might not have been their first choice, but they may have a situation where they really need to access that capital. How do you differentiate yourself as an originator as the place to be for this money?
Another great question. We differentiate ourselves with process and having the ability to successfully flesh out deals early on before we issue an app to secure, what we like to think certainty of execution. The last thing we ever want to do at our shop is miss something up front that comes back to hurt us the day before closing and obviously upset the client. We have the unique ability to really utilize our $20+ billion special servicing portfolio for all types of data points that can effectively show us, if the deal we're underwriting today is going to, has a higher probability of performing well or not performing well. And having that in-house B-piece buyer approval, before we get to closing and before we get to securitization is the most differentiating factor in our platform. Our goal is to really, obviously we're spread driven. We want to generate market spreads, but the only way to really get good spread and fair spread is to to have the best process in the business, and that's really what we strive for. Because to us, that's what generates repeat business, and we want to be around for a long time.
It's funny that you talked about certainty of closing. We actually did a survey that looked at 186 borrowers. What was their number one most important factor when they're looking to choose a lender? And certainty of execution was number one. So you've definitely got the right point there in terms of getting new business. So as they're looking at you, are they looking at a CMBS shop that has a lot of different things in their portfolio?
Great question. For now, we are just a basic blocking and tackling CMBS shop. We're doing fixed rate 5, 7, 10-year deals. Our real sweet spot is the $5 to $35 million deal. We are not afraid of going up the leverage scale. We're also not afraid of doing lower leverage deals that have to get priced accordingly. We're just looking for good quality real estate. We're not afraid of colorful borrowers. That's an unfortunate part of CMBS 2.0. But we're open-minded, and we're just looking to see as many deals as we can right now.
Okay. Well, we'll look to have you be a very active player in 2012. Thanks for joining us, David Auerbach. Pleasure to have you.
Excellent. Thank you.